I'm Nick. I'm head of finance and analytics at Moonfire Ventures. So we are a European seed stage fund that's trying to take a slightly different approach to venture. So we have more engineers than investors and are kind of building this or have built this AI native investment platform that goes from sourcing screening to kind of all stages of the investment process. But I've been there for about a year, and then before that, I actually spent the last 15 years mainly on the startup side. So Uber, Babylon Health, and then more recently CFO of a coastal-backed neurotech company. And so seeing the FX risk mainly on that side of things, but then obviously been very exposed to it as we are a US dollar denominated fund here at Moonfire, and all of our expenses are in euros and pounds. And so that was kind of initially how we came across Bound, that and obviously on the investment side. So keen to talk to you all about that a bit more.
Hi everyone. Mark from Connect Ventures. I'm CFO here. I joined the firm about 9 years ago now. We just launched our second fund at the time. So we're also seed stage VC, um, investing out of relatively small funds and leading sort of 25 deals per fund. Um, I got a small team with me at Connect. We're only 7 people in total. I've got one other person in finance, and cover kind of all areas of the finance function, like I'm sure most of you on this call do. Our funds are set up as GBP funds, um, and all of our management company costs are in GBP, so we don't have any FX issues on that point of view. But we make investments in euros and dollar predominantly, and pounds. So our FX risk comes up on making those investments and also exiting them.
I go first.
Yeah, do you want to go? Go for it.
Awesome. Yeah, I think it's interesting because I think Mark and I kind of cover two slightly different parts of the FX risk, which so I think this should be interesting. But ours is largely on the management fees. So obviously US dollar denominated fund, all of our expenses in pounds and euros. And so that creates massive problems from a kind of budgeting perspective, not only because of the FX risk, but also because, as I'm sure you have with many other VCs on this call, a lot of your costs on the VC side tend to be fixed, as most of them are kind of people costs, or from ours, we have large data providers, which are kind of multi-year contracts. On top of that, we're also growing. So we've got two funds live at the moment. We're fundraising for our third. And so there's hiring, there's kind of ramping up on the data side. And so being able to plan long term in terms of who can we hire, when can we hire them, what data contracts can we sign up for is something that we're constantly looking at. And then when you have kind of the US dollar softening by 10% within a 6 month period, that can really affect your planning. And so being able to understand what our purchasing power is long term is super, super key for us. So I'd say that's big problem number one. And then the second is on the investment. So while we are a US dollar denominated fund, we do quite a lot of investments in euros. And so we spend a lot of time making sure that we minimize cash drag. And so we use a combination of facilities, plus we put any excess cash in FTFs and similar things like this. And so that requires us to be relatively precise on the amount that we're taking out and when. And so being able to know the exact investment amount, weeks in advance is super helpful. And so Bound is also useful from that perspective. That's a kind of other FX risk is on the investment side.
Yeah, I think for us, as I say, so we're GBP fund and making investments in GBP, euros, and dollars. So for us, it's really kind of one of precision, and we're drawing down money from investors in pounds, making investments in dollars, and it's just sort of being super accurate about the amount that we draw down, so that we can trade that FX and buy the right number of dollars that we need to, and kind of do that in good time and with good certainty. So in the past, when we kind of didn't have much of an FX strategy, we'd essentially call down the amount of pounds based on the FX rate at the time, add a buffer in case the FX rate moved, and then we'd kind of do the trade. But we weren't ultimately sure how many pounds we were going to need when we were doing that. So we were, really exposing ourselves to currency moves between drawing the pounds down or making the view on how many pounds we needed, and then buying the dollars that we needed. And having gone through various, we had Brexit and all sorts of other things that happened. We were seeing like way more volatility in the FX markets over very short periods of time. And that kind of caught us out a couple of times where we suddenly needed way more pounds than we thought, like 10% swing in a couple of weeks, and that was like not a good place to be. So a couple of bad experiences, and then we kind of wanted to move and find ways to have a better FX policy, basically.
Yeah, so I'm sure this is the same for everyone here, but management fees, we get paid quarterly. And so what we effectively do is, in order to do our long-term planning, is we hedge as far in advance as we can. So at the moment, we're hedging a year in advance, but we're looking to increase that even further. And basically what we do is, when it comes to the management company, the most important thing for us is predictability. And so knowing what the rate is that we can plan at. And so we use actually all three of the bound products, but the main one we use is a ranging product. So how it effectively works is you can sort of set the amount of US dollars that you want to sell. So our management fees coming in and we hedge the full amount. And then you can set a range for what you want it to convert at. So a kind of an upper bound is sort of the maximum you want it to convert at, and the lower bound is kind of where you would like it to convert if the market drops. And that gives you a couple of things, which is as the market kind of trades, if it hits that upper bound, it will then convert to that amount, and the same thing with the lower. And so what you're really setting there is the upper bound is effectively your budget rate. So you know your management fees for the next year that it will not convert at an amount that is higher than that. So you can sort of plan to that. But then the lower bound gives you this upside. So if the market improves or you see things getting better and actually it triggers at your lower bound, great, you've beaten your budget rate. That's additional money in the pot. And so we love that structure because I think when I was doing this in previous companies in the past, you're basically spot trading for future periods to protect or not doing anything at all, which is in itself an FX decision in some ways. And then you're kind of getting to the end of your budget period and you're basically seeing these massive swings because of FX. And so this takes a lot of that uncertainty out and gives you that kind of long-term planning. But the other piece that I quite like about it, which we implement is, and then this thing that I actually haven't seen in other FX platforms is Bound has this sort of trailing stop feature. So you've set this range. And what you can enable is that as the market improves, your upper bound actually starts to come down and track the market. And so that basically means that if it does improve, let's take today's example, we're at 1.35 pounds to the dollar. So I would probably set my upper bound at 1.4, I'll budget to that, maybe my lower bound at 1.32. If the market starts to track down, my upper bound will come down. And then if the market bounces, it will convert at it. So it will basically lock in some of the market trends over time and allow me to get a slightly better market upside if that happens. And I think just overall, I think when we do this management fee hedging, the goal is never really to beat the market. I'm not necessarily planning to just kind of generate savings off of FX, although that does actually happen quite a lot with some of these products. It's more the predictability, and that's basically what it allows us to do. And we tend to layer that with a combination of putting most of the money in the hedging through the ranging product for that certainty. And then if we start to see certain improvements or things, then we use some of Bound's other products like the averaging or the spot trades just to kind of take some money off the table at a point where rates looking good, it makes sense for us. So it kind of has that multifaceted approach from being able to manage your risk. But the main way we use it is for predictability.
Yeah, I think our use case is much more plain vanilla than Nick. So I don't envy your management company situation there. It's complicated. But so from our perspective, it's all about certainty and calling the right amount of pounds down from investors. And we really, one of my goals is really to like minimize the amount of cash that's sitting in the investor bank account, essentially. So when we have a new deal and it's in foreign currency, typically, a seed stage deal can take anywhere between like 4 to 8 weeks probably to complete. But during, so you're going from like signed term sheet to completion, basically. But during that time, there's always a little bit of uncertainty. I haven't seen it happen very often, but deals can occasionally fall apart. Um, so we're sort of sensitive on to the time when we need to cool down the money for investors, and then also when we're going to lock in the kind of trade with Bound. So to do that, we use like a forwarding product. Um, and as the deal becomes more certain and we're kind of approaching that completion date, we'll coordinate the drawdown from LPs, and at the same time, we'll lock in like a 2 week forward with Bound, and it will tell us the exact amount of dollars. Um, Obviously, because we know the amount of dollars we need, sorry, but it will tell us the exact amount of pounds that we need. That money comes in from the investors. Um, we operate on a 2 week drawdown window, like I'm sure most people do. And then when the pounds come in, we trade it to Bound, and Bound sends us back the dollars. And then we can fire that out to the company once the deal has completed. So it's pretty simple, really, but it's just kind of working on the timings and locking everything in, and being certain about what the rate is and how much we need to draw down.
So from our side, we have the opposite problem, which is where all the funds are in US dollars and then our investments are usually in euros. And I think we spend a huge amount, or we did spend a huge amount of time trying to minimize cash drag, and so making sure that we're not pulling too much cash from LPs. And so one of the ways that we do this is if you have this kind of, let's say, pre-bound world where you don't know what you're going to convert into euros at that point, you just always draw an extra buffer, because for a lot of the deals that we do, actually, sometimes the amount and the round size actually changes as the deal is evolving. And so what we'd usually do is we'd pull the maximum out and add a little bit of a buffer for FX. You end up overdrawing and you end up holding extra cash where you shouldn't. And whether you're holding that just in normal accounts or in FTFs, you have to be quite specific about when you need the cash. And it would just end up with this over buffering effect, which is not good for LPs, it's not good for IRR, it's not good for yield on that amount either. And so what we tend to do is we would basically use it is actually a similar approach to Mark, where we would forward trade the amount, and we would tend to do that quite early in the deal stage process. So as soon as we've got clarity on that, and we're in a similar position where it's seed stage, things move pretty quickly. We do a lot of pre-seed as well, which is even faster. But we're seeing increasing number of cases now with Series A, Series B, our companies graduating. We have an opportunities fund as well, which does more Series B onwards. And in those deals, it can evolve over months, and the FX exposure can change massively over that time frame. So we're seeing it become increasingly important. But I would say for anyone out there who's doing kind of a later stage, I can see this being, even bigger problem for them, perhaps.
Yeah, I mean, it's really similar to the making of an investment, to be honest. So this is exits where we predominantly receive exits in euros or dollars. And it's again trying to create certainty around the amount of pounds that we can trade back. Um, Exits again, there's kind of like a lot of uncertainty on timing. Um, and these things always take way longer than you think, and there's a risk. I think the risk the exit risk, I think, is higher than like the making of an investment. So and by that I mean like things can fall apart. So it's judging a bit of a judgment call on when to kind of like lock in the trade, and how far to set your sort of forward. um, So we actually used the ranging product for this. So we had a deal complete in Germany. It's signed, but then everything has to go through a notary process. Notary process is like typically an absolute nightmare, and it can take like another 4 to 6 weeks. So we knew the deal had signed. We knew we were going to get back however much it was. And we had the ranging product out there for like 6 weeks, but we knew that we could end it earlier if we needed to. Again, we kind of protect ourselves against big market swings essentially. Whereas in like prior worlds, you know, we knew that we would be getting a certain amount of euros back, and then the market swings, and that really hurts when the amount of pounds that you're going to be giving back to your investors kind of moves quite wildly as a deal is closing, and you feel pretty powerless to kind of protect yourself.
Anything I'd add just on both those, which I didn't really touch on before, is that I think my experience is mainly on the strategic finance and analytics side, so I actually don't have a huge amount of kind of treasury management experience. And so, except for when I was CFO of my previous firm for a couple of years, it always seemed something that was quite scary, a little bit complicated. We worked a lot with our kind of incumbent banks like Bank of America and HSBC, and the processes are quite arduous and complex. And so I think for people who may be in a similar position to me, I know a lot of VCs tend to merge kind of finance and operations and legal roles. And so you might have other people that haven't really done this before. I think one of the reasons why I do love the bound product is it makes it very simple. So you're not having to deal with a lot of the complexities that you have to deal with hedging and if you're dealing with incumbent banks and in general, I think people, including myself in the past, like overestimate how complex and difficult it can be. And actually, in reality, it's very simple through the platform, but it's also not very time consuming. And it's probably the same for a lot of you guys and girls out there, but we have kind of one of those roles where we wear many hats. And if I'm spending more than 30% of my time on actual finance, then I'm not doing the other parts of my job. And so I have to make this very quick and very efficient. And I find that that's why you kind of do, if you do find a solution for this, make sure you find one that's quick and easy to use, tech first, something like Bound. I think it hits those targets. There's also some unpredictability sometimes on the management fees and the investment side. It can often change versus what you put in, particularly if you're raising a new fund and you don't know at what point you will have closed new capital, but you want to hedge some of it. And so I think we've had some of that in the past. And one thing that we do in the platform, which you can do, is let's say you have accidentally overhedged, you can actually shift some of your hedge to a later date. And obviously you keep the rate that you've locked if the range is closed or the hedge is closed, but you can push it out to a later period. And particularly with VCs where you tend to have a semi-consistent flow of income, so you can kind of use it to fill up your next quarters of investments or management fees if you've still got stuff to deploy, if you've still got fees coming in. So that can save you from that situation in those aspects. But I appreciate exits is obviously a bit different.
Yeah.
Honestly, the opposite. I would say I don't need to do any reporting on what's happening in Bound because I just use the UI in Bound to work out what's happening with my hedges. And I'd say from a reporting perspective, it's useful because we know in advance what we're locking in the fees for, and so we know what we basically know. I think from a budgeting perspective, and when we're doing kind of internal financial reporting around how the business is actually doing and what additional capital we have to spend, I think it simplifies it. And I'd say from a kind of general financial reporting perspective, it doesn't really add any complexity.
Yeah, yeah, the same for us, really. I think we would just have to, if we had a liability out there where we had a trade that we needed to settle and it crossed a quarter end, I think we'd need to recognize that. But it's pretty straightforward. It's pretty straightforward. And the platform is just super easy to use. So you kind of get full transparency on it. You manage it internally.
Okay.
Yeah, yeah. Because we don't have a payments mandate with our administrator. So we do all the payments ourselves in the funds. So we give the fund administrator access to the bank account, but they don't set payments up for us, and they don't authorize them.
We use a combination, so we do everything internally for the management fees just because it's a management company, but also it's one that we want to stay closer to. But actually, we use Bound for the investment pieces where they will kind of know roughly what they should be doing for the investments, and they will actually execute in the Bound platform for us. So it's even more hands off from that perspective, and we kind of have a set of, I guess, guidelines or rules that they follow. And if anything falls outside, we just touch base, but it's quite low touch from my side. In general, they're used to working with more complex systems, I would say. So I mean, we use HFL, and they yeah they had no problem switching across.
Yeah, good question. I mean, they should do it, really, they should be doing it as soon as they have like a currency exposure. So we have companies that base in the UK, but they raise in dollars. Um, and, if it makes a difference of a couple of months to your runway, it's like a no-brainer to do it straight away.
Pretty involved. I think usually just to answer the threshold question, it tends to be around the Series A mark that we tend to get more involved because that's usually when they've raised a kind of larger amount. It's almost always US dollar denominated. And so many of our companies are European, so they have European headcount spend. And so at that point, we tend to basically recommend they have some kind of FX setup, but also they tend to not have any kind of yield generating accounts either. So they often have, 20, 30 million sitting in there not generating any interest. And so we tend to do them together and set them up with them. And we usually just have like a list of recommendations that we send, and Bound is on there too.
Uh, I just find the platform a lot more transparent and straightforward, I guess, which is the main thing that attracted me to it originally. Um, you can see the rates live on the screen. You're not just speaking to someone on the phone, and it just makes for like a way better experience. And I tend to think,
Yeah, and I'd say for me the one thing maybe we haven't spent as much time on is that I love is the UI, because I think yes, I hated about doing this in the past for me was the time sink, when I think you're spread really thin and you want something that is really, really quick to use, but also very easy. And I think, yeah, it's super, super helpful for that. And you kind of, my team thinks I'm doing all this really complex smart hedging, and I'm probably spending about 2 minutes a week actually in the platform setting this all up. So it's kind of a win-win for us there.